Welcome to Talk Tickers. This deep dive is dedicated to one of the most critical yet least understood pieces of market plumbing: order handling.
That's right.
Today, we're unpacking a massive regulatory shift from the SEC, an absolute overhaul of disclosure requirements that touches nearly every broker-dealer in the U.S. equity market.
We are breaking down the intricate details behind the recent amendments to SEC Rules 600, 605, and 606.
Yeah.
These rules fundamentally redefine how broker-dealers have to disclose their routing and execution strategies, particularly around conflicts of interest like payment for order flow or PFOF.
And the mission of this deep dive is to give you an actionable understanding of these changes. I mean, if you route orders or if you manage money, these new disclosures are the tools you will use to truly assess the quality and cost of your broker.
The SEC's goal here is pretty simple, really: enhance transparency and force greater competition.
But the way they decided to achieve it is the real story.
And that's the crucial pivot. The Commission explicitly abandoned its previously proposed approach, which was, defining institutional disclosure requirements based on a rigid, specific dollar value threshold. I think they threw out a number like $200,000.
That dollar value approach was frankly a bit clumsy, wasn't it?
No, it was. It was deemed flawed because it just created these messy boundaries. A $200,000 threshold could capture a massive, simple retail order,
right, while
completely missing a smaller but highly complex institutional trade that required specialized handling. It was both over-inclusive and, under-inclusive at the same time.
Okay, so instead of using a dollar amount, the SEC decided to classify the required transparency based entirely on the nature of the order itself. This is the core shift we need to understand.
Yeah.
The move to distinguishing between held and not held orders.
Precisely. The new regime hinges on whether an order is held or not held. This distinction is paramount because it dictates the level of discretion, the freedom afforded to the broker-dealer in managing that order, and therefore where the biggest conflicts of interest can arise.
Let's start there then. What is the fundamental difference between these two order types, and why is that distinction now the key to this whole new disclosure regime?
A held order is pretty straightforward. When a customer gives their broker a held order, the broker-dealer is required to attempt immediate execution.
Okay.
They have virtually no discretion in handling the order's timing or price. Think of the typical marketable retail order: buy 100 shares of XYZ right now.
Meaning the broker has to either execute it immediately at the quoted price or just send it somewhere that will.
Exactly. Conversely, a not held order grants the broker-dealer significant discretion. The customer is essentially saying, look, I have a large volume I need to move, but I'm giving you discretion over the timing, the specific pricing, and the overall execution strategy.
And that's the hallmark of institutional flow.
It is. It's where sophisticated algorithms are used to break up a huge parent order into thousands of smaller child orders, executed over minutes or hours to minimize market impact.
So the moment discretion enters the equation, the potential for conflicts around routing decisions just increases exponentially. The rationale here is to focus on where the broker is making active, strategic choices. Is that right?
It's much cleaner, and it's highly aligned with industry practice. I mean, market participants, especially institutional desks, are already deeply familiar with classifying orders this way.
So they're not reinventing the wheel.
Not at all. This classification aligns with global standards used in reporting systems like FENARA-OATS, which is the industry standard for tracking an order's lifecycle, and the FICTIX protocol, the electronic language for securities transactions.
By using this established framework, the SEC is directing the most intense custom disclosures precisely to the segment of the market where that broker-dealer is exercising discretion. It makes a lot of regulatory sense.
It does. It focuses detailed scrutiny on sophisticated trading strategies rather than trying to use some arbitrary dollar amount to define what's sophisticated and what isn't.
Okay, let's shift to the details of those intense disclosures. We're talking about a massive win for institutional customers seeking data, the newly expanded Rule 606b3.
Right.
This rule governs the reporting for those not held NMS stock orders. And NMS is National Market System stocks, which is, basically all actively traded U.S. equities.
This is a fundamental change in the relationship between a broker and their client. Any customer who places a not held NMS stock order can now request a detailed, customer-specific order handling report.
And the broker has to provide it.
And that disclosure is mandatory upon request.
You mentioned detailed. How fast does the broker have to produce this, and what kind of format are we talking about? Because for an institution, a standardized format is just as important as the data itself.
You hit the nail on the head. The format is standardized to facilitate robust data analysis across different brokers. It has to be delivered using a standardized XML schema, which is machine readable, with an associated PDF renderer for, human consumption.
So a big institution can just ingest and compare data from 10 different brokers seamlessly.
That's the idea. That machine readable requirement is huge for comparability. It allows investors to run their own independent assessments of routing quality.
And the timeline.
The report must cover the prior 6 months of activity, broken down by calendar month, and must be provided within 7 business days of the request.
Wow.
Think about that turnaround time for 6 months of detailed, granular trading data. It forces brokers to maintain serious, accessible data infrastructure.
Okay, let's unpack the actual data points. These reports are highly granular, broken down by the venue the orders were routed to, and strictly segmented between directed orders and non-directed orders.
Directed is where the customer dictated the venue, and non-directed is where the broker chose.
So what are the key performance indicators they have to reveal?
Well, we can group them. First, you have order routing metrics, which detail the shares routed, how many were marked immediate or cancel, the total shares that were further routable, and the average order size routed.
Okay, that sets the stage for the broker's strategy. Then we move to the financial and quality metrics.
Right. Under execution metrics, the broker must disclose total shares executed, the fill rate, which is shares executed divided by shares routed, and the average fill size. But here's the kicker.
What's that?
They have to report the average net execution fee or rebate, measured precisely in cents per 100 shares, specified to 4 decimal places.
4 decimal places. Why so granular? That seems like absurd precision unless the SEC is trying to force them to reveal something specific about their economic model.
That extreme precision forces them to reveal the microscopic economics of their routing revenue. It eliminates the ability to obfuscate tiny aggregated amounts of revenue or cost through rounding.
I see.
If a broker is receiving, say, 0.0002 cents per share in some unusual rebate arrangement, they have to report it. They also have to disclose the percentage of shares executed at the midpoint, which is a key measure of price improvement.
And what about the crucial liquidity interaction metrics? When you're managing a huge institutional order, you aren't just looking for execution, you're monitoring how your activity impacts the market.
That's where the liquidity metrics come in. The report forces disclosure separating orders that provided liquidity, those executed after resting on the book, and orders that removed liquidity.
So passive versus aggressive orders.
Exactly. And for both, they must list the total shares executed, the percentage of shares executed, and again, that hypergranular average net execution fee or rebate for each.
The disclosure requirement related to actionable indications of interest, or IOIs, is also a major inclusion. This seems to address a huge institutional concern: information leakage.
Absolutely. An actionable IOI is essentially a communication from the broker that conveys the symbol, side, size, and price. It acts as a functional equivalent of a quote or order.
And if you're moving large volume, you don't want anyone to see your hand prematurely.
Not at all. By mandating disclosure of IOI activity, the SEC gives customers the ability to monitor and assess the specific risk of information leakage associated with their broker's use of these sophisticated pre-trade signals.
So if a client suspects their large trade is being front-run or anticipated, they can now directly request the data that shows how often their broker was flashing IOIs related to their order flow.
It creates an audit trail that just didn't exist before.
Yeah.
Now, to be fair to the smaller players, there are 2 crucial de minimis exceptions built into 606(b)(3).
To relieve compliance costs.
Right, for those who don't primarily service institutions.
Walk us through those safety valves.
First, the firm-level exception, or the 5% rule. A broker-dealer is exempt if the percentage of shares of not held NMS stock orders they receive from customers is less than 5% of their total NMS stock orders over the prior 6 months.
So if your business is 95% held retail orders, you get a pass.
You get a pass. And the second exception is the customer-level exception, the $1 million threshold. A broker-dealer is exempt for a specific customer if that customer traded, on average, less than $1 million of notional value of not held orders monthly through that broker.
So the rules are really designed to focus the scrutiny on meaningful professional volume.
Exactly.
That's a thorough breakdown of the institutional side. Let's transition now to enhanced retail transparency, focusing on Rule 606A. This is where the public-facing reports for held orders get a serious upgrade, especially concerning PFOF.
The scope of 606A now applies to all held NMS stock orders of any size. That old dollar limit is gone.
Yeah.
And crucially, these public reports must now be broken down by calendar month, rather than just being a quarterly aggregate. This increases the timeliness and utility of the data for anyone tracking execution quality.
And the major focus is shining a spotlight directly onto the economics of payment for order flow. How has the transparency around PFOF changed in these public disclosures?
It's no longer enough just to say you receive PFOF. Rule 606A1 now mandates that brokers must publicly quantify and report the net aggregate amount of PFOF received.
The actual number.
The actual number, along with profit-sharing income, transaction fees paid, and transaction rebates received. And this has to be shown both as a total dollar amount and on a per-share basis.
So the general public can calculate exactly how much their broker's making off their order flow. But it's not just the money they have to disclose, right? They have to disclose the terms of the deal, which is maybe even more telling.
Absolutely. The qualitative disclosure is just as critical. Brokers must describe any oral or written terms of PFOF or profit-sharing relationships that could potentially influence routing decisions.
Meaning things like volume tiers.
Yes, exactly. Revealing specific incentives like volume-based tiered payment schedules or bonuses for meeting certain order flow thresholds, that description helps customers gauge the severity of the potential conflict.
What other details about the order flow must they now publicly reveal?
Well, the routing information itself has to be broken down more intelligently. It now has to be separated into marketable limit orders and non-marketable limit orders.
And why is that distinction so important?
Because whether an order is marketable often determines whether it is routed to an OTC market maker, where PFOF arrangements are most prevalent, or to a lit exchange. Providing this separation gives a much clearer picture of how PFOF is influencing different types of orders.
I found the change in stock categorization fascinating. They removed the requirement to divide reports by primary listing market like NYSE versus NASDAQ.
And instead, they opted for a categorization based on a liquidity proxy. The SEC determined that execution quality varies more meaningfully based on a stock's characteristics, its liquidity, its volume, than simply where it happens to be listed.
So what's the new grouping?
Reports must now categorize NMS stocks into two relevant groups, those included in the highly liquid S&P 500 index and other NMS stocks. This just gives a far more useful context for comparison.
This all leads to the core intellectual debate here. Best execution. The entire point of these disclosures is to ensure customers are receiving best execution. But does the market already enforce this through competition, or is that PFOF conflict just too powerful?
That is the central question hanging over U.S. market structure. If we connect this to the bigger picture, routing decisions are already intensely competitive.
Right.
Empirical analysis confirms that brokers actively monitor wholesaler performance, meaning the execution quality provided by their market makers, and they reward those who provide better execution with more order flow.
So it's a constant, measurable feedback loop where better execution quality translates directly into future market share.
Precisely. We know from analysis that for some retail-oriented brokers, evaluating a wholesaler's performance based on the past 30 days is a crucial factor in their routing decisions. This indicates high-velocity performance monitoring is already built into the system.
But the structural conflict created by PFOF remains, even with that competitive monitoring. What effect does that payment structure have on the overall market beyond just the individual retail customer?
That's the key market externality. The PFOF structure means marketable retail order flow is overwhelmingly executed off-market via internalizers. This filters out a huge volume of generally less informed flow from lit exchanges.
And the consequence of that is?
What the systemic consequence is that the remaining market makers and institutions trading on those lit venues interact with relatively more informed flow, which measurably increases their risk of adverse selection or toxicity.
So the retail customer gets a superb instant price off exchange. But that process might be imposing a hidden cost-increased risk and uncertainty on the sophisticated institutional players and market makers on the primary exchanges. It raises the cost of providing liquidity for everyone else.
That structural tension is what these new disclosure rules aim to address by giving customers the data to quantify that trade-off. And to put this in sharp relief, we can look at the UK market, which provides a fascinating natural experiment.
Remind us of the UK situation with PFOF.
The UK clarified PFOF as illegal back in 2012. And what happened next is really telling. We saw an immediate, measurable improvement in execution quality on the public exchanges.
How significant was that increase? Was it just a marginal change?
Far from marginal. The proportion of retail-sized trades executing at the best quoted price on the London Stock Exchange increased from roughly 65-67% in 2010 to over 90% by 2014.
Wow, that's a huge jump.
A jump of nearly 25 percentage points. It provides powerful evidence. It strongly suggests that a highly competitive market can achieve extremely high levels of best execution once that direct conflict of interest from PFOF is explicitly removed.
So what does this all mean for you, the listener?
Well, the new SEC rules represent a massive, multifaceted push for mandatory transparency. For institutional customers placing not held orders, standardized, XML-based reports are now mandatory upon request.
Focusing on metrics of discretion, cost, and information leakage.
Exactly.
And for customers placing held orders, the new public reports mandate granular, quantified disclosure of PFOF economics, both in total dollars and per share, and require that new stock categorization by S&P 500 inclusion to provide a more meaningful context for comparison.
The overall effect is designed to increase efficiency and competition by forcing every broker-dealer to reveal the data necessary for customers to accurately assess the true cost and quality of their routing strategies.
Our final provocative thought for you to consider is this. Given these massive disclosure changes and the ongoing debate surrounding market structure, we have to ask ourselves if this increased transparency will be enough to resolve the systemic tension between retail internalization and institutional execution quality. You now have the detailed disclosure metrics to watch for. The next few years will tell us if transparency forces evolution or if more structural change is required.